good morning. You're watching The Market right here in ET Now with me, Aisha Faridi, Nikunj Dalmia, Avan Bash in the studios. And yesterday, yes, we did start off at that 20K mark, but eased off from there and quite a bit of chop and churn. I think more than what was happening with the index is what was happening outside the index. The fact that you had that kind of a swing come in the mid and the small cap end of the market, the fact that the Midcap index alone fell about 3% and the small cap index was down 4%, that sort of brought about some amount of jitters, at least on the street. And acute profit taking, one would have to say. I mean, nowhere are we indicating that this is a trend reversal of any sorts, but massive bout of profit taking in the frenzied names, your railway, defense, power stocks, all of them.
So if you look in isolation, yesterday's price action, it will look outright ugly. Now extend it and say that, okay, what's been the 3-month trend? You would say that, look, this is an overdue correction which had to come and which simply has kicked in largely because of what has happened to the excess built up in the market. Now in isolation, yes, it was outright ugly. But all bull markets, they correct. It was simple law of gravity which was at play. I don't think the bull market is over. But what this kind of a correction will do, that if it will shake out the weak hands, it will test the temperament of leverage buyers. It will force you to think that equity as an asset class will have volatility and will have risk. I still feel that even though the shakeout will look outright ugly, you want to still avoid buying the big fall. I'll say it again. In a bull market, you should buy the fall. But in some of the overhyped sectors, especially some of the PSUs and some of the other overhyped sectors, I think you should wait for a couple of days before you plan your entry, because after such a rise, one day of fall may just not be good enough. So you got to take the market as it moves rather than prejudging an entry strategy. The bull market is not over. This market will give you entry points, but I think the entry points could be at lower levels rather than jumping the first fall. You know, Aisha, typically when you see a rally like this, the lot of FOMO crowd, lot of Johnny-come-lately crowd would say, okay, markets have corrected, now let's jump back in. I think the market is still overextended. The rise has been linear and it has been stupendous. You don't buy the first fall, but you want to be a buyer on the dip. I think the entry point will come maybe later this week or early next week, but you just got to time yourself very smartly if you miss some of these stocks. Yeah, but I'm a horizon of 2 or 3 years, then there's nothing to worry. Then this will look like a seasonal correction. But this is a must overdue correction. It will shake out the weak players, it will give entry points, and finally strong players will kick in. That's how markets move.
Yeah, and you know, given how sharp the run-up in these spaces has been, the small and the mid caps, the correction may not stall here, right? I mean, like you were saying, for a long haul player, 10% may look like minuscule and par for the course. But because of the run-up and the swift run-up in these names, it's going to fall a lot more. It will get uglier before it gets pretty.
Yeah, technically what I understand is that if you look at the RSI levels, even after a 10% correction, they're still overbought. Yeah. If you look at the historical P multiples, after a 10% correction, they are not cheap. So either technically things have to just calm down a bit, or the stocks have to give you some kind of an appeal. I still maintain that these stocks are expensive. You must not buy the first fall. The bull market is not over, but the reason why you should not buy the first fall is because they have not become attractive enough even to be part of your long haul portfolio. Just wait it out for next couple of days. This is not going to be market technicals and the macro setup and what we understand when we speak to the market investors. This is not going to be a prolonged ugly correction, but it really could be Wednesday afternoon, or it really could be Thursday morning, it could be next Monday morning. Wait for a couple of days, let the dust settle down, let the calmness in the market come rather than buying the first fall in terms of just participating.
Okay, a quick check-in on the global setup, and it was down in the range of about, a quiet cut of 0.5% to about 1% across the board is what we witnessed. Asia as well, for the most part, is in the red and clearly eyeing some data coming in from the US in terms of the inflation numbers, and there's some data points from Japan and South Korea. For now, the gift Nifty indicates that it could be a minor positive start this morning. But just going by the other data points then, and as per Goldman Sachs as well, the overall cash levels for the top 200 active equity mutual funds, That stands at about 4.2% versus the long-term average of about 4.1%. The small and the mid-cap mandates hold high cash levels of about 5 to 7% in terms of the AUM, and the large-cap schemes have about 3 to 4% in terms of their overall cash allocations. Just going by this kind of data, Nikunj, what according to you is this indicative of?
So what is the relevance of this data? The relevance of this data is that in the markets have run up, mutual funds are sitting on more than necessary cash, and you got NFOs which clearly are on right now. So this market is not going to get into any kind of a free fall zone until unless something changes on the global macro front or the local front, which means that domestic institutional investors have enough and more cash, SIF flows are strong, and they are likely to be buyer, I wouldn't use the word buyer of last resort, but they are likely to be the backstop for this market. And if you have strong cash levels and strong flows, that means the downside in some of the institutional dominated stocks, I think will not be very large. Now what happens to HNI and retail dominated stocks? Well, that's a separate kettle of fish, but cash levels are decent. Maybe they've been waiting for declines, and if the decline kicks in, we've learned that the flow of domestic, the support of domestic flows, irrespective of the FI liquidity, I think is decent enough right now. Luckily, the NFOs and the flows into equity diversified schemes also is very decent enough. I mean, kudos to the retail guys, they know how to do risk management right now. So I don't think from a market liquidity standpoint, even if markets fall, there is going to be a crunch situation per se. Imagine if cash levels were low, imagine if NFOs were not there, imagine if SIPs were not picking up, then you would have made an you could have made an argument for a liquidity vacuum. Right now there is enough and more liquidity cushion in the market which will arrest the free fall until and unless something changes globally. I mean, what could change globally? A risk off moment, something macro, I mean, a war-like situation. If those things don't happen, then you cannot make a case for a big free fall, at least in some of the quality mid-cap stocks and large-cap stocks.
Yeah, and that churn is clearly evident, right? Like we were talking yesterday, that banks could very well be the new defensives. You are seeing money flow into banks and even IT.
I think banks is the new defensives, and I would stick my neck out and say that in this rally, if something has scope and potential to outperform, I think it really would be banks. Variety of factors are at play right now. One, the cycle is just strong. B, the comfort level with institutional investors when it comes to investing into banks, I think is supreme. C, the valuations are no longer stretched. Fourth, they've underperformed. On the macro front, keep the crude part aside, but CPI inflation print yesterday seems to be coming down. Interest rate seems to be getting benign. There is no problem in terms of the balance sheet and what is happening there in terms of how things are moving. So the setup, valuation, underperformance, and the bent of the market is such that banks really could be defensive, new defensives. What are defensives? We were discussing this yesterday, Aisha. Defensives are the ones where you want to buy when the market is looking nervous or markets are looking at rotating. If there is one sector where defensives market will take comfort from, I think would be banks. The old definition of defensives was IT, pharma, consumer. Why? Yeah. IT was a play on global outsourcing, consumer was a play on India consumption or demographics, and pharma was a play on outsourcing. But I think IT is shaky. Consumer stocks are expensive and divided because of rural versus urban, and pharma is a difficult sector to call. So what is defensive? Where you have comfort of earnings and visibility for next 2-3 years. I think for me that's banks now.
They cushion the impact, I guess, of the market volatility to a certain
extent. Yeah, Avan, in the last cycle banks were not defensive because banks had all kind of crazy exposure, power, road, steel, and they were like the ugly duckling. Now it's a matter of timing, it's a nature of the economy. The ugly duckling, so to speak, has become the swan in the market.
Oh, yes, indeed. And you did touch upon the overall macros as well. So just going to revisit that. The fact that you had the August consumer price index, that data coming out at about 6.8%, easing off from what we witnessed last month at about 7.4%. The food inflation continues to remain elevated at about 9.9% levels, and the CPI rural inflation figure has eased off, albeit very marginally, to about 7.02%. But that aside, it's good news for all the Apple fans out there because there were a slew of launches that came out this from their annual launch event in Apple Park in Cupertino, California. And they unveiled the iPhone 15, the iPhone 15 Plus priced at $799. They also unveiled the phones iPhone 15 Pro and Pro Max upwards of $999. From the basket Of launches, there was also the brand new Apple Watch and AirPods. They have been updated. So the new iPhone can have a Type-C charger instead of the Lightning port. The shift to a USB-C chargers for the iPhone 15 is going to mean that Apple users' old Lightning cables will no longer work. So they're just making us spend lots more money, I guess. But these events are surely looked forward to.
Nikunj, upgrading?
No.
No?
Very happy with what I have right now.
And
Apple
I see three Apple products right here on the
Four.
table.
I think even Kunal has an Apple
Yeah,
phone,
so
right?
all clear fans, pretty cool stuff that has also been launched, as we can see on our screens. Okay, that aside, let's also find out, aside from Apple, what were the global commentators talking about? Lots on their minds with respect to the inflation commentary. Let's find out from Harsh what exactly all of that was. Morning, Harsh.
Well, good morning, Avan. We'll start off with Mohammad Al Arian. Well, he suggests that UK, of course, GDP data awaited today, but UK on unemployment as well as on earnings, well, those numbers are unlikely to deter the Bank of England from further hiking rates in this cycle. That's what he believes. He also feels that going forward, though, the commentary will start getting more and more dovish. They will moderate their expectations as to how high rates will actually go. So some relief for markets going forward is what he believes. Let's quickly move on to Peter Schiff. He's also suggesting something very similar with regard to US markets. He's saying that the Fed has already secretly given up on its 2% inflation target. Very interesting there. And next, it will quietly drop price stability as its mandate. The new unspoken mandate, he believes, will be with regard to the financing of government debt and forestalling any financial crisis, no matter what that actually entails. So he is quite bullish with regard to the fact that the Fed will start to get dovish going forward. Lastly, we have Howard Marks talking about risk-adjusted returns. Well, he believes that in school he learned about how higher the risk, higher the return works, but he believes that's not the case. Alpha investors can go into the market, apply their skill, and access upside potential offered by the market without taking incremental risk, and that's the key, he believes, to generating alpha. Very interesting comments coming in from Howard Marks' latest letter as well.
Okay, we leave it at that. Of course, we will be taking up Howard Marks's latest letter and discuss that as well in greater detail. Lots lined up on the show, but first, let's welcome on board our chartists. We've got Naresh Mirani, Kunal Bothra joining in as always. Gentlemen, hi, morning. Kunal, today I don't want to talk about the Nifty. I want to talk about what was happening in the mid and the small cap index. That 3% fall in the mid cap index, 4% in the small caps. Are we in for further weakness in store?
Well, we should be in for more weakness, and because when we see the first round of correction like what we saw in mid caps and small caps, it generally is not an aberration. It's a trend in the making. Now, what we need to understand is that what are the sectors and which are the kind of stocks which would probably go into a correction. So there was a list of stocks which had risen exceptionally high in the month of September so far, and most of the stocks in that phase of rally have actually seen correction of 10 to 15% on an average so far in the last couple of days. Some of them corrected by 10% or more. Even yesterday, and some of them were on a lower circuit, the mid-cap names or the power stocks which we were discussing yesterday as well. So there's a decisive or a pronounced weakness which has come back into these kind of stocks. Now, every minor bounce would be actually taken as an opportunity to try and cut the leverage, cut the positions, reduce the risk. So I'm pretty certain that if there is any kind of a bounce, even on a day like today, we could probably see more profit booking as well as more cutting of positions rather than building of long positions, which may ideally not be the case at least over the next couple of days. So net, I'm expecting weakness to continue in the mid caps and small caps for at least another couple of days.
All right, Naresh, let's get in your take then. And that move unnerving pretty much within the broader end of the market. Would you also suggest that it was inevitable given the furious rise upwards?
So if we look at purely from the price perspective, what has happened to the mid cap and the small cap index? So if you look at the Nifty small cap 100, it was closer to 11,800 on 25th August when Nifty hit 19,250. It went all the way to 13,000 levels. The BSE small cap was closer to 35,000 odd levels. It went to 38,700. So in the period of time where Nifty went up, say roughly 600 points and less than 5%, the mid cap and the small cap indices went up by 10-11%. So yesterday's move of almost 3 to 4% down still makes it a little more or in line with the Nifty move in the current rally. So it's just a correction of over exuberance which was there on the mid cap and small caps. But that is how corrections play out. So out here, the last swing low for both the indices are at least another 5-7% away from current market prices. And that would make it a 10% fall from the top, and it would still be a normal correction. So for now, that is the case. Say, first indications finally of a shakeout, which could get into a correction towards whether it goes all the way to 10% or stops at 8% is a tough thing to call. But the fact is, we are still in line with the Nifty, and this was normal because we went up 10-12% when the Nifty did only 4-5%. So we are just normalizing. So this is a correction. So somebody who's looking to de-risk, somebody who's overexposed to small caps on rise can look at an asset allocation call.
Okay, let's talk stocks then. Naresh, what's on your radar?
So would remain defensive given the first indications of say a correction on the mid cap, small cap indices, but the Nifty did not do so. And we are around the previous highs. We could take it out with momentum as well, or would take some pause and then go ahead. So I'd go with two large caps. First is a buy on ICICI Bank. The stock is turning around from the 960, 940 band, which was there on the lower end. And the last 3 days, it has shown relative strength. A move about 1010 would confirm a much bigger breakout. So a buy on dips here, stop loss at 960, target price of 1080 in the short term. Second is a buy on Power Grid. The stock went ex-bonus today, corrected 2-3% from the top. Defensive bet here again, stop loss at 184, target price of 220.
All right, Kunal, let's find out what's on your radar then, and what is it that you're tilting towards in terms of your preference this morning?
So I'll favor the large cap names, and I think over the last couple of days we've seen large cap stocks outperforming. Two stocks which I would suggest as a buy. HDFC Bank, the stock still remaining quite firm at the 1630 odd levels yesterday on a flattish, closed on a flattish note. So would suggest a buy with 1680 as a target, stop loss at 1600 mark. And TCS is the other stock which has given a breakout yesterday, confirmed a breakout after multiple swing highs for the stock. So that would also be a buy, short-term targets of 3625, stop loss at 3545.
All right, there you have it, your top technical recommendations being flagged off by our chartists. But what about the top stocks to watch out for in trade? We've got Anisha right here to discuss just that. And Anisha, let's begin with the first stock then, and that's Bata India that we're discussing. They're not sprinting, they're not making strides, and looks like maybe they're just about crawling. What does Citi have to say?
Yeah, Citi doesn't like the pace at which they are crawling. They are the market leaders in terms of the market share. But what they point out is that the growth has been very, very sluggish for Bata. In fact, if you look at the CAGR of last many years, the volume growth has been pretty much zero. No surprise then that the company has managed to lose the market share as well. In fact, if you look at the revenue CAGR from FY19 to 23 as well, this is the lowest that we have seen from the rest of the top 4 listed peers as well. And the consensus estimates right now is giving them a valuation of almost 45x, which is unreasonable as per them. And this means that on a reverse DCF basis, they are expecting a 17% growth going forward, which is higher than what the company has been delivering. So overall, it's a sell call coming in from Citi. The target price stands at 1310, which is a solid 400 rupees lower than the current market price, Nikunj.
In Anisha, 45 P with no growth and with no visible trigger in the near term, markets will always call it expensive. And also now the options I think are clearly available. I mean, what has also taken the sheen away from Bata is that you got Metro and you got Campus Footwear, and they have a different kind of uniqueness in terms of what they offer for investors. Earlier, Bata was the only go-to space in terms of a quality footwear company, which was a claim on per capita income, great brand, and a whole promise of expanding into tier 1, beyond tier 1 to tier 2 and tier 3 cities. The Hush Puppies and the experimental branding, the retail outlook, it did very well. It never became a digital success, if you frankly ask me. But now with no growth and losing market share, and if Metro and Campus Shoes are doing much better, I guess Bata is not the preferred stock. Also, I don't think in next 2 quarters anything will change for Bata. You may say that, okay, there is a cyclical downturn, so markets will give it benefit of doubt, but markets have given Bata benefit of doubt for 4 quarters now.
Yeah.
Maybe 4 quarters now. So it's an underperforming stock. Anything which is not growing in this kind of a market with P multiple of 45 plus, and when other footwear companies are giving you something much better in parallel, and with very less impact on terms of online, Bata has not been online success. I think Bata has been an underperformer, and that really could be the risk going forward.
Yeah, the omni-channel presence hasn't really worked out for Bata, so not really putting the best foot forward per se. But
There used to be a time when Aisha, Anisha, Avan, Bata ki jute.
Yeah.
Right,
That was the only brand, right?
Well, Hush Puppies. I mean, it was like a formidable office wear brand.
Coveted brand.
And then Bata school shoes.
Yeah.
And Bata school shoes also are in a sense getting challenged, at least in urban India. And then Bata Hawaii chappals, they've also got challenged. So there are a lot of pockets where Bata had a dominant market share, and it's a great old brand started by Thomas Bata. They had a lot of land in Bata, a little bit of trivia here and there. But I think now they're not really occupying that recall when it comes to the consumer.
Yep, there's also so much more out there.
No, sneakers, everyone's wearing sneakers, we're forgetting that.
Yeah.
Let's think about it. Sneaker craze. Bata is not that big in sneakers. They're trying to come back, but you don't relate with Bata as a sneaker brand. That's a problem.
Yeah, you always think of it as a school shoe slash Hawaii
and
chappal
you all remember
brand.
those iconic ads that were there, right? So that's the kind of recall value there.
For us, at least, it remains there. But that's not the case. Nuvama's pretty bullish on Star Health.
Oh, well, yes, it's calling it the pole star of retail health, saying, of course, it's a market leader. And if you look at the second biggest player, Star Health is actually 3x the size of that in terms of various metrics as well. No surprise then that they've initiated with a buy, and the target price stands at around 770, which is a good 130 rupees higher than the current market price. Now, they are saying that, of course, retail health is one of the most profitable and one of the fastest growing segments of insurance, and Star Health has a very strong presence there. And it's supported by a very large agency force. Plus, the product suite is quite large and extensive. There have been steady renewal rates. Even if you look at the loss ratios as well, they are very comfortable. In fact, the loss claim ratios have been between 60 to 66%. And even if you look at the old legacy business, their loss ratios have been close to 70%, which is still reasonable by the industry standards. Going forward, in fact, the management believes that there is a upside available in terms of improvement in the loss ratio, and they see multiple levers for doing that as well. So overall, very positive about Star Health. But Nikunj, we have been talking about how if you're looking at playing this entire health insurance theme, perhaps Star Health is really the best play.
So since it's a positive note, let me be the devil's advocate and let me tell you that what are the challenges. Number one, there are old P investors who've been looking at reducing their stake, and I think it's, see if you look at the block deal pattern in the last couple of weeks. Second, Star Health, remember the one big difference, Kunal, Aisha and Awan, if you buy health insurance and life insurance, is that health insurance has to be renewed every year.
Yeah.
Unlike life insurance where you are locked in for years. I mean, you rarely change your life insurance, right? You've locked in with a company, you've locked in with an LIC or an HDFC, wherever you are. You don't change it every year. With health insurance, that is not the case. Every year the churn, I think, is very high. So what is looking like a good number could actually get challenged, Anisha, given that, how every year there is a definite churn which is happening. Now the good news, the return ratios are fantastic. The CD ratio, which is what our viewers, I would like to point out, just to simplify it, in the insurance business, they are making money. Unlike a lot of other health insurance companies, they are actually making money out of float, not by selling insurance policies, they're selling money by making insurance policies. The stock has done little, precious little, and they're also looking at changing their model. They went into corporate wholesale, which has not done very well for them, so they're coming back. So if I outweigh the negatives versus the positives, the negatives right now are less and the positives are more.
Yeah, okay, that's the take coming in at Star Health. Bata, Anisha, thanks for highlighting those two stocks. But the one sector, or rather the two sectors, which really have been hogging the limelight of late, first after the run-up and yesterday with the profit taking that transpired in both railway as well as defense names. So let's try and understand from a slew of experts, what is it that you should be doing with these two investments?
Exuberance is very much evident, Nikunj, in my opinion, in these railway and defense companies. But again, I believe these companies are in that long haul moment, with a long runway. So so there can be, some of these great companies with great future, there can be correction. And it can price-wise correct 20-30%.
Every time people come in this market with a new theme, with a new dress and new concept, and ultimately that concept lasts for maybe 6 months or 1 year, or maybe 2 years sometime, and then they fizzle out. I'm not saying the story in those stocks are over. The story may play out maybe for a decade or so. but valuation is too high and there is euphoria in this market. I will not buy those shares. And this is what I can say.
I would definitely urge that this is not the time to just blindly get into something because there's a name defense or a railways or a shipbuilding or an EMS attached to it. Be discreet. There is, as I said, lot of opportunity in these sectors.
Whenever any rally becomes parabolic, it usually does not sustain, and that's clearly happened in defense and railway. And we have been recommending aggressive profit booking in both these spaces in the last few days, and we continue to recommend the same because I think this is just crazy because people are just factoring in too much into the future, discounting too much into the future, which I don't think is right.
All right, that's the market opinion coming in as to what the outlook is ahead. But on that note, let's hear it out then from some corporate voices. With the festive season around the corner, Motown is leaving no stone unturned to make the most of the surge in demand. Let's hear out some of the top automakers in the country as to what they expect from the festive season.
See, the festive season already started in August, especially when we talk about Kerala, where Onam has already started. We are already into 20-25 days of that period. And we are seeing quite a strong growth, and you are seeing the industry also taking off from August. So we believe that this augurs well for the festive season, and we should be seeing a very strong demand in the festive period. And in preparation towards that strong period, we are ensuring that supplies are being ramped up.
The SUV segment as a category has been growing from strength to strength month on month. The category has been growing relatively faster than the overall passenger vehicle segment. When the passenger vehicle segment is growing at about 15%, the SUV segment has been growing at over 20%. Now, if we talk a little bit about M&M, August has been our best month so far. It's our highest record month. And the reasons why the performance has been so strong, couple of points, and that also kind of plays into the festive season.
So I think the good part of this festive season is it's spread over 4 months. It is generally everything happens in September and October, but this time Diwali is in November, Dussehra is in October, Ganesh Chaturthi is in September, and Onam happened in August. So it's a spread over period, and that actually gives us a bit more time to also do production and cater to the market demand. Coming back to the demand, I would say the order intake is great. The moment we introduced the GLC, it was sold out, and a lot of deliveries happening there.
See, I think the MHCV industry is not so much affected by the festivities, right? But that is already growing well, and I think that growth momentum will continue or better from what we have seen in April to August period. LCV industry is a little bit slowed down in April to August. We were expecting a growth of about 5 to 6%, which has not happened. But I think with this festive season, LCV industry in any case is affected more by the festivities, etc. So I think this is a good moment or good period of next couple of months that we'll see LCV industry also turning around and getting into a good growth mode.
Back with the market right here on ET now. The implied GIFT Nifty is indicating once again a very quiet start. So let's see whether the bout of profit taking from yesterday continues or not. Not just for the Nifty, more importantly for the mid and the small cap indexes. But all you Apple fans, in case you're wondering what got announced overnight, let me take it across to Sumita, my colleague, and get a lowdown.
Well, the event was trending on Twitter. In fact, the biggest reveal, as we had told you right here on ET Now, is that Apple will now be using its newest USB Type-C charging for AirPods and, in fact, for its phones also, after a tussle with the European Union, which basically means that you'll have to spend less on those chargers, on buying them separately, and you can use one single charger for all your Apple products. Now, the lineup pretty much remains the same as last year, with minor or incremental changes, I'd say, to most of the devices, but we'll come to the key highlights. But let's take a look at what all products were offered. Number one, 2 base models, as we had told you, Apple iPhone 15 and iPhone Plus, which come with last year's biggest Pro model feature, in fact, the Dynamic Island, which is a pill-shaped cutout display to show activities and updates. And in fact, last year's A16 chipset is also featured on these two base models, including a better camera. Let's now come to the Pro models. Well, Apple has ditched stainless steel for a new titanium frame, which is more durable, which is lighter. It also has a faster A17 silicon processor, which Apple claims is the fastest chipset on any phone and has a spatial video feature, which can be integrated with Apple's Vision Pro device. It has great camera updates and, of course, better photographic capabilities. But this time, Apple is promoting gaming in a very, very significant manner. And this was one of the big takeaways, one large takeaways. The processor, in fact, is designed to take advantage of some AR apps. And Apple is also bringing some popular apps and popular gaming apps like Resident Evil on its Pro variant. Let's now move on to the other options. Well, there will also be a new silent button will be phased out for a customized trigger specific button, which will be available on the phone's sites. And then other than that, there was Watch Series 9 and Watch Ultra 2. These were, of course, newest variants with advanced metrics to detect blood flow. And of course, Siri can now take commands offline as well.
All right, Sumita, thanks very much. So actually stand corrected about that charger, that you can use the one charger now for a lot of Apple products across the board. Okay, that aside, let's put the spotlight then on macros and the latest inflation data. CPI has risen at 6.83% compared to a faster clip of 7.4% in July. Morgan Stanley and Goldman Sachs have come out with their notes. We've got Harsh here to tell us what the brokerages make of it. Harsh?
Well, yes, food inflation at 9.2%, definitely moderating, and that's another positive on the back of softening vegetable prices and vegetable inflation. In fact, core CPI has also dropped around 20 bips, 4.7%. Definitely a positive across the board. What we're seeing from both Morgan Stanley and Goldman Sachs are positive notes. Well, the August CPI moderated more than expected, than what at least Morgan Stanley expected. Core inflation is at its lowest since May 2020, and the policy response, they believe, Morgan Stanley believes, is going to be a rate cut cycle starting second quarter calendar year 2024. So, of course, need to wait and watch out as to how that plays out, but at least in calendar year 23, they are not expecting any rate hikes or cuts. Quickly moving on, you are seeing Goldman Sachs as well. They believe August headline inflation was below expectations on their mark as well, on the back of cooling vegetable prices. They reaffirm their view that the RBI will look through the current surge in inflation as well as food inflation and take comfort from the decline in core inflation as well. They also believe that RBI will maintain a hold with regard to the repo at 6.5% for the rest of this calendar year.
Right, okay, let's move on and let's talk about the pharma sector, which has been in focus on the back of heightened M&A activity as well, even as the borrowing environment remains tense. Joining the bandwagon, in fact, is America's Biogen Pharma that is looking to sell its biosimilars business. Let me take it across to Sharad, my colleague, and try and understand what exactly is in the works. Sharad, perhaps DRL could be a potential suitor for this?
Well, yes, the company Biogen is actually evaluating selling its biosim business, and of course this will be a major cost reduction program which they are actually evaluating, and they'll be planning to sell this unit, and this will be important because of actually going into the innovative medicines as front. But what the market is expecting is, of course, they might believe that Samsung Bio also might be one of the important suitors because both of these companies are having long-standing relations. But as per Macquarie, it's expected that from the Indian pharma pack, Dr. Reddy's could be an interested player, and of course this would actually help Dr. Reddy's to increase their commercialization pipeline and also a significant introduction, especially coming in the top line numbers. Now, of course, Dr. Reddy's is having a net cash balance of roughly $608 million, and of course the company itself is having aggressive plans, especially coming for its biosim business in the European and the American markets, and this would add the missing commercialization piece which would be there coming for the company. Also, do remember the company has already collaborated with Merck, and in this, the strategy of change, Merck will actually not impact the company going ahead. Now, the Dr. Reddy's is again focusing on the biosimilar business, and this would actually augur well for the company as well. So, this is a pack coming in. This is a kind of a pack coming in from Macquarie for this acquisition as well.
All right, thanks very much for giving us those details. In fact, let's discuss some individual stocks then. And Naresh, given the fact that we saw that absolute meltdown yesterday in a lot of the rail stocks, what exactly are the charts indicating? That it's a bit of a pause or that there's more downside to go?
So ideally, would expect more downside given the move, the size of the move across the board. A lot of stocks went up 3x to 6x from the March lows, or say in the last 1 year. So in that case, you would expect at least a 20-30% correction from the top. So if I were to take an example of RVNL, say back in 2022, it used to trade around 30-40 levels. The stock has gone up to 190 levels. And even in March, the stock used to trade around closer to 50 odd levels. So it's gone up 4x, 3 to 4x from March lows. So out in this case, if it made a top around 200, a 20% correction or 25% correction from the top would be normal. So stock going down from 200 to 150 would be a pretty normal case. We've gone to 170 yesterday. So all the high flyers which went up massively, more than 100% in the last 5-6 months, could correct 20-25% or even 30% from the top. So the whole railway pack is placed in that. More importantly, after this fall, they should go sideways for maybe a couple of months at least, or even more.
On the other hand, Kunal, some of the key heavyweights which chipped in yesterday, right? And I'm going to pick up three here. TCS, L&T and ICICI Bank. Do you see further strength there?
Well, yes, I do see further strength for many of the stocks in this space. Even add to the fact that HDFC Bank was a lot more resilient. Reliance was more or less muted at a range of 0.5% or so on closing basis for the stock. So there are large cap stocks which could probably lend support for, to the index at least over the near term. And I think in terms of strength, we could also be seeing a pattern of shift from these mid caps, small caps, or the two-digit names which have been flying high to these solid stocks. So I think that could be a gradual shift of pattern as well as a churn, which is a natural course which happens in every market trend. So even when the index corrected from 90,900 mark, there was a change in sector pattern. Even with the rise from the 90,300 levels almost 2 weeks back, there was a change in sectors and change in pattern for the market breadth. So I would probably sense that with every market correction or a new phase in the market, there is bound to be a sector change, and hopefully this time around we could see these large cap stocks making a durable comeback.
Naresh, let's pick up L&T in specific. Now we're eyeing 3,000 a level on L&T. What's the reading on the charts, both in the very near term and even the medium term?
So, say in the near term, like all of us were expecting a move towards 3,000 as a target price. That has been done. We broke out. The trend has stretched a little in the last 3 months. So the stock broke out from 2,200, 2,300 levels, and it's gone up to 3,000. So now it has caught up with the Siemens and the ABB and the other capital good names. So time for some pause. Yesterday was a very high volume tick also. So out here, I would expect, say the upside is a little limited in the short term, say 3,000, 3,200 is the band. So at current levels, the risk reward is not great. But I would not expect it to correct below 2,750, which is where it made a big gap move from. So ideally would look towards a dip towards 2,800, 2,850 to look for a buy. So for now at 3,200, it becomes a case where you want to sell. At 2,850, you want to buy.
Let's get you some more stock-specific ideas. And this time, from a fundamental perspective, here's Sanjeev Bhasin telling us what he's liking in this market.
In a long time, I have not seen L&T hit new highs. So has NTPC. So has Coal India, which has surprised, 220, 270 in almost a couple of months. And it's telling you industrials, power, hydrocarbon, engineering, electrical, this space is rocking and there is no two ways. Cummins, Thermax, ABB, Siemens, you name it. L&T takes the cake. Now their order book is so large and the execution is, always questionable for the PSUs, but not for a private company like L&T. And now they're talking of double-digit margins. So I think power, infrastructure, and the likes of L&T, Coal India, NTPC, and I'll give you a couple of dark horses on the mid caps, which I think can be equivalent to the return, which if you are looking for that. But L&T overweight, NTPC and ONG, Coal India are also three overweight stocks for us. Coal India which was discarded because of thermal and other issues, is now revving up. And I think that this whole Ukraine-Russian crisis has actually turned out to be a blessing for them. You see the dispatch numbers. It's the third largest producer of coal in the world. And I think it is just getting its recognition.
All right, let's shift gears then and put the spotlight on banks. Nikunj, let's discuss this in greater detail. Just owing to the kind of triggers now that are in place, The question is, are banks the new defensive?
They are, and I would stick my neck out because, with banks, they have this reputation of being volatile. So, of course, banks will be volatile. That's the nature of the business. But in the near term, when I say near term, you say anything defensive, why? Because you expect it to fall less and you think there is visibility. Where in the market can you see there is visibility and there is a comfort of valuation? Very few sectors. Banks is one of them. The YTD move in the bank Nifty versus Nifty underperforming. The most talked about sector this year actually has underperformed. Throw in the macro elements, well, interest rates are looking benign, NPA conditions are looking okay. And the credit offtake, I think, is decent, even if you look at the retail side and if you look at the unsecured and the secured loan. That, I think, is important. Then other valuations, whether it is Kotak Mahindra Bank or whether it is, whether it is HDFC Bank or whether it is Axis Bank, all these stocks are nowhere close to the historical averages. State Bank of India has done hardly anything. Now, that's how things have moved actually 12 years forward. See, this, let's spend some time here, Avan. This is the 5-year average.
Yeah.
So, on a 5-year average, Kotak Mahindra Bank has commanded a price to book of 4, which means 2.8 is the current price to book. So, Kotak Mahindra Bank is trading at a discount to its historical average. And growth in next 5 years will be higher than the previous 5 years.
So that's,
Growth will be higher and valuations are cheaper. Then when you see a equation like this, when X equal to Y, that is the time to just buy. So I think this graph, is very simple to explain that why banks have a scope to outperform and why they really could be the new defensives.
Okay, there you have it, putting the clearer picture as to why Nikunj is making a case for banks being the new defensives, Aisha.
Oh yeah, absolutely. In fact, let's pick up that point forward with Rahul Shah as well. Rahul, do you believe that banks which have been underperforming in the last leg of the market move could be the performers now? And would you then bet big on, say, an HDFC Bank, an ICICI Bank, or even the PSBs for that matter?
Hi, good morning. I think, as you rightly said, I think if you look at the earnings of the Q1 and what we see, we make out of this entire basket, if we look at it, I think the performance was good. Only thing where the costs have gone higher for them. But I think if you look at the loan growth portfolio across the sector, be it the retail, be it the MSME, be it the corporate book. So if you look at, for most of the banks, private banks as well as the PSUs, so I think this has been the case for most of them. Secondly, I think what has happened is that asset quality is improved in all the banks. So I think except for Bandhan, I think all other banks are the asset quality is improved. So my sense is I think when we have a market roaring higher and higher, and if we are looking at some kind of the risk versus reward kind of strategy, and where we see that the limited downside in most of the banks. And I think this typically last year and a half, we've been seeing the good credit growth and the numbers have been pretty strong, quarter on quarter upbeat on most of the banks. So my sense, I think the entire banking should do well. Yes, the preferences starts with SDFC Bank, but no brainer. The stock has underperformed 3-4 years now. I think it's if I look at the Nifty levels and if I have to decide, then I think this is one stock we cannot go wrong. So I think SDFC banks remain the top preference in that, and obviously followed by the PSU banks. I think PSU pack, I think entire PSU pack, the large including SBI, and I think the second rounds like Canada and Jammu and Kashmir Bank. All of them looks very, very interesting as a pack by the banking.
Why are railway stocks down? How much more can they fall? And would you avoid railway defense and power stocks right now? Rahul Shah.
So I think railway stocks, I think if you see that we had a fantastic run-up. So I think if we look at an entire theme, I think entire defense as a theme, or if you look at this entire railway segment as a theme, yes, the orders by the governments, and I think the stocks have done well, but now I think there could be some break. So the stocks have run up quite sharp. So maybe I think there could be a halt in these things for the entire railway pack. Secondly, I think power stocks, I don't think so. There could be there's a temporary jerks. I think we've seen that markets had got a fancy, and we have seen that a lot of power names did quite well. So maybe this is just a halt, but I personally feel that I think still overall the growth stock for the power as a sector in India will remain strong. So maybe PSU pack NTPC remains the top bets. Valuations are reasonable, and after a long multi-year, if you look at the stock has started performing. So I think I remain positive in the entire power sector. So top preference NTPC, followed by I think Tata Power and JSW Energy.
Okay, that's the take coming in on which way some of these power and frenzied railway and defense names could actually head. Let's take a look at some of the other movers in trade. And, we've been highlighting what the brokerages have been saying about Star Health, what the call is on Bata as well. Nuvama has initiated a buy, like we earlier highlighted, on Star Health with the price target of 770 now. So that's going to be one stock which is going to be in focus. And then, of course, there's Bata as well, wherein there are concerns about the valuation that you're seeing on the stock right now. Citi says that the company has only lost the market share. It's a 0% volume CAGR over the past decade that they've posted, and the consensus estimate already factors in the 17% revenue CAGR that they claim to be posting. Rahul, do you believe that it could be disadvantage Bata and maybe advantage a Relaxo or a Campus Footwear? Because clearly, the dominance of Bata has gotten challenged.
No, but my preference still will remain with Bata. I would not go with Relaxo or something. So I think, I don't think so the earnings were good for Relaxo. So I would avoid Relaxo for sure. Bata, I think, obviously, the stock has done nothing in terms of the overall performance if you look at it last couple of years. But I think if someone wants to remain in this segment, then I think Bata would have a preference. Although I would not recommend buying either of them at this juncture. We would wait for some correction, and I would advise to get in at some later rates.
Let's now look at consumer tech and fintech. Why are we going back to consumer tech and fintech? Because again, they've also done well. I mean, why just talk about railway and defense stocks, consumer stocks and fintech, consumer fintech and financial fintech stocks have done rather well this year. Zomato, Policy Bazaar, even for that matter, Paytm. So Naresh, if the tide turns, which it has turned in some cases, could it also turn for these stocks?
So I would say a correction, if it comes for almost everything. So it doesn't matter which sector it is. So the point is, we are seeing that Paytm stall around that 930, 950 mark. The base is at 750, 800. So that would make it a 10-15% correction from the top. So out here, a lot of names which have moved up can correct, say a normal shakeout could be 10-15% from the top. So Zomato has been stalling around 100, 105. So we have not seen a blown out move from here on. So a correction of 10% is what I would expect in all the names. But if you look at the structure is still pretty positive. A 10-15% correction is where you actually want a correction so that you can start participating back into these names. So the structure is positive for the whole new age tech companies. We went through 8 to 12 months of a bottoming. We've gone through a 3 months of trend. We could go for a few weeks of a correction.
Kunal, where in this market would you want to add positions? Or would it be an obvious one, IT and banks?
Yeah, I think as of now, banks and IT, because you will have to probably play defensive when the market gets into a sell-off mode. And Aisha, it's very difficult to try and figure out just prior to the start of a corrective wave that how far can this correction last. Now, for example, if in the next couple of days, if most of the leverage positions go out of the market, then we could probably see the corrections settle a lot more earlier than what one would probably anticipate. But if the leverage positions, they don't kick out, and you see these leverage positions still there in the markets, then the sell-off could be a bit more aggressive for these stocks. So it's very, very difficult to try and anticipate which kind of market texture would play out going forward. So the first put of call is shift back towards defensives or the large cap names, the one that is the one space or many of the spaces where the correction has already happened in the last 2-3 months. Take, for example, the FMCG space. I think the likes of HUL, Britannia, ITC, etc. These stocks have already corrected by 15% to 20% on an average from their June-July highs for themselves, which means that there could be a lot more higher degree of cushion into these stocks going forward. Even the IT names, for example, the large cap ones specifically, there could be a strong case that with many of the stocks breaking out of their multi-month highs, we can expect that this momentum would at least sustain, if not build, largely for many of these stocks. And even for the private sector banking names, the view would be very similar.
Okay, that's the take coming in on some of the IT names. But I also want to discuss furthermore what was happening within the liquid universe yesterday. Look at the crack that you saw on names like a BHEL, for instance. At the peak of the day, it was down about almost 11% or so, and finally shutting shop in excess of a 10% cut there. There was Indiabulls Housing, which lost another 9.5% in trade. REC was down about almost 8.5%. There was GMR Infra, which cracked quite a fair bit, about an 8% downtick coming in there. And some of the metal names led by Hindustan Copper that saw a fall of about almost 8% or so. Rahul, within the cap goods space, and I'm going to keep L&T out of this gamut, but a BHEL for instance, A, your thoughts on the same, and B, if the stock corrects further, would you look to add positions or even buy afresh?
So I think if you look at the entire PSU as a basket and maybe including the caps and power stocks and the few names which you mentioned like REC and all. So I think in the entire space, they would run up also quite sharply. And I think there's a lot of speculative element which happened. And if we see that volumes were gone higher, and that is what we saw some kind of liquidation yesterday with the correction in the Midcap index as well. So I think that's one part of it. Second, I think if we look at the entire cap goods as a place, so I think my preference would be more on the terms of the private players, rather than BHEL. So maybe at this price, I would avoid BHEL. Maybe at correction, I would look at it for a longer term play. But if I have to look at something like Siemens or something like ABB, though the valuations are expensive, but I feel that there will be a safety and the risk versus reward would be quite favorable from here. So I think again here the returns could be also a very moderate kind of a return. The stock has done well, so I think these are only 12-15% compounder from here. So that is what it looks like. So my sense is I think again Siemens and ABB remains the top bets in that entire sector.
Nuresh and Kunal, let's spend some time here now. Everybody wants to know the following questions. Question number 1, Nuresh. Within the ranked or within the outperforming sectors, defense, railways or shipbuilders, not that the tide has turned, which is the weakest one and which is the strongest one? Which is one stock you will not buy in the decline and which is one stock you will buy in this decline? Nuresh.
So I would not be buying, say, railways as first, then defense. A lot of these names which went up the most, the smaller cap names, a lot of names like small cap names, Centech, RVNL, etc. In shipyards, Mazgaon Dock, which has moved the most, would not be a buy. Same is the case with the GRSE, which has moved up of late. So I would not be buying any of these names as of now. So generally, if you had a 6x move, 3x move from the top, a correction could go all the way to 30% also. A minimum correction should be 15 to 20% from the top. So anything less than 15% from the top, you don't want to buy. And at 30%, you want to review, which is where you get a starting point. So the whole sector would wait some more. It's just been a 1 day of correction.
Kunal, the same question for you. In this fall, which are the names you will not buy and which are the names you will buy?
So railways, defense, power, and especially the ones which have, the two-digit stocks from the power space, all of those stocks is something which I would definitely not buy. In fact, I've not bought it in the previous rally as well. But even in this phase of correction, I would anticipate that the correction would be very sharp for these stocks. Even the likes of railways and defense, I think that they've gone through just the first couple of days of correction for these stocks, and I believe that they've not yet retraced to their 50-day moving average. That should be the least retracement which should happen. Now, in terms of the stocks which I would look to buy, maybe the real estate stocks, if they come back towards a decent support zone, for example, the likes of TLF, Oberoi Realty, Anantraj, if these stocks they come back closer to their 50-day moving average or slightly lower, then I think that could be an attractive proposition to go long.
Okay, so very important. I just want to bring this point out for our viewers. Our technical experts are of the view that in this fall, the first fall, don't try and catch the falling knife. Don't do it. Because when stocks after this parabolic move, if they correct, the depth of the correction could be much more. So avoid buying defense, avoid buying railways, and avoid buying two-digit stocks. And a lot of them actually, in terms of what is there on the table. Kunal, would you buy a Zomato or a Paytm or a Policy Bazaar in this fall?
Yeah, Nikunj, I think that would still not be a bad bet because these stocks did not have a parabolic rise. By parabolic, I mean, or meteoric rise. So Zomato, I think, bottomed out in last year, June or July at 40 odd levels. The stock was at 50, 55 till December 2022. And it's just in the last 6 or 8 months, the stock had seen a steady up move. Maybe a return of 40%, 50% or slightly higher in the last 3 or 6 months for a stock like Zomato. Even the likes of Paytm, Policy Bazaar, it's not as if that these stocks had become extremely overbought. They had gone through those periodic phases of correction. In fact, in just the last month, I think if I'm not wrong, the month of July, the stock of Zomato made a high of 102, 104, corrected back towards 86, 88 mark and then rallied back towards 100 odd levels. I think that's where the stock is settled into. So that itself tells you that when you have such kind of neutrality in terms of indicators, the stocks, they generally don't get into an overbought, and when stocks are not highly overbought, you don't expect a sharp correction into these names. So for example, if we expect maybe a 15-20% average correction into those high beta spaces, we can expect less than 10 correction as an average correction for many of these stocks, and that could be a good opportunity to enter into these names.
Okay, meantime, wanted to get in your thoughts, Rahul, as to what the outlook is when it comes to the entire auto space, going by the kind of fervor that they are talking about within the festive season, the kind of positive brokerage notes as well that we've seen on the entire auto space. Where is it that you would like to pick and choose?
I think two fundamental thoughts about it. One is obviously the domestic demand has been very, very strong in terms of the entire auto pack. Second, I think with stable commodity prices, and I think there will be a margin expansion. And third, that ease of chip supply. So all these three things have been augured well for the entire auto as a whole. So what we believe is, I think CV play will be one of the preferred bet, and we see the demand consistency coming back into that CVP. So I think two large players, I think Ashok Leyland and Tata Motors remains the top bets in this segment. And obviously, when we talk about the passenger vehicles, so Maruti remains the top preference in that. So if I have to, vis-a-vis two-wheelers versus all these things, so I think our preference would be CV8, followed by passenger vehicle, Maruti.
Okay. 620 Tata Motors. Rahul, I get a sense that a lot of inventory built up has started with auto companies. Is there is the expectations running very high for autos? Because if inventory built up is happening, if demand is not strong, then it could be back to square one, no demand, high discounts.
So I think if we look at it, after long time, I think we've seen this come back into it. I think after 3 years, I think that we've been seeing that shortages. I think, as you rightly pointed out, that I think there was a waiting, and now we've seen that inventory started building it up with most of the auto companies. So, but I think still the demand is pretty strong with the new launches also in the pipeline. So I don't think so. Immediate for next 2 quarters and so on, doesn't look like that there could be a problematic in the auto as a space in passenger vehicle space.
The implied Nifty, now what is the meaning of the implied Nifty? That means that while markets were shut yesterday at 3:30, Nifty or GIFT Nifty traded. In the morning, it traded again. So from yesterday's close, Nifty is set to open 16 points higher. So it is not the real value of GIFT Nifty. What matters is the Nifty implied open, right, Kunal?
Yeah.
So what implied Nifty is telling us that Nifty at 9:15 will open 19 points higher.
Yes.
That is the most important number. It is not the real value of GIFT Nifty which is important.
Yeah, because GIFT Nifty is broken into 2 parts. One is yesterday's close and the other is today's open. What we see is today's open, but we have to adjust with yesterday's close as well.
You know, it trades for 18 hours, I think, now?
Yes.
Wow. 18 hours is what GIFT Nifty trades now. 2054. Kavish Karthike on LinkedIn. Who's Kavish Karthike? I'm still an employee of StockGen and I hold my post with utmost pride. Now, why are we referring to this LinkedIn quote of Kavish Karthike, who is working with StockGen? Well, believe me when I say it, and I'm saying it with a lot of sincerity, that a lot of social media groups yesterday started carrying unsolicited, unconfirmed, rumor-based nonsense, which was targeting StockGen, and it was accusing one of the dealers for front running, and that in a sense caused the selling in the market. Look, markets were due for a correction. So let's not just blame it on StockGen or an individual. What was important is for us to point out that the mid and the small cap space and the micro cap space had become Humpty Dumpty. It was just obese. It was due for a fall. And on top of that, in today's world of social media, all kind of things they float around unconfirmed, and there was this big rumor yesterday. But Kavish Karthike has come out and clarified on LinkedIn. I'm just quoting him. I'm still an employee of StockGen and I hold my post with utmost pride. Kunal, was this a point on social media yesterday?
Yeah, it was a point of discussion. I had received a forward, but when I spoke to a few of my colleagues out of India, they say that this may just be rumors, may not be true.
Markets will have to connect everything for a fall, right?
Yes.
But I think markets overdue for a fall. So why look for a reason? Simply say that an overbought market just corrected. That's a simple explanation what happened yesterday, right, Kunal?
Absolutely, yes, Nikunj.
Suresh, without getting into A, B, C of what is right and what is wrong, blaming anybody, putting the blame on somebody, the markets were due for a fall and they simply corrected yesterday.
So it's a little funny. The Excel sheet which is going around is something which we had done a working of some deals and I put it on some group and people just took it around and sending it in terms of that the whole basket is being sold, etc. Because there were deals which were happening from a fund which did not used to happen regularly. So it was just there on our radar. And the market just needed a reason. So people create a reason or something happens somewhere. So out here, it is basically when you have a market which has rallied a lot, it just needs a reason to correct. So that yesterday, the whole rumor thing happened out of nowhere. It started with something on Reuters, then somewhere else. So overall, just another day which needed a cool off, and that is what has happened.
You want to have a question?
No, I was actually going to look at some of the interesting movers in the week gone by and get in a take from Kunal, but I believe that it's 9 a.m. so it's time for the mid-cap recommendations. Why don't we get straight to that then, Kunal? Your top mid-cap call?
Well, I'll go with a mid-cap IT name, L&T Infotech Mindtree. The stock still perched at 5,500 odd levels. Looked to be quite okay in terms of yesterday's market close. So would expect the stock to get into a strong rally mode, at least over the near term, looking at how the large cap IT stocks have behaved. So 5,700 as a target and stop us at 5,400.
All right, that's LTI Mindtree. Let's find out, Naresh, what's on your radar today?
So would be going short on Trent with a strict stop loss at 2,100. The stock has rallied a lot, not seeing much of a correction, a bounce today. Could be a risk reward trade here for a short term dip to 1950 or lower levels.
All right, there you have it. Those are your top recommendations. But let's move on and track some of the other top headlines. The Nipah virus scare, well, that's back in Kerala. There have been 2 deaths that have been reported. According to the Union Health Ministry, 4 suspected cases are currently under surveillance. Their samples have been sent to the National Institute of Virology in Pune. Meantime, more than 10,000 people are feared dead or missing in eastern Libya after a devastating storm Daniel caused flooding. Several dams have been destroyed in the floods and hundreds of buildings have collapsed. Search and rescue operations are underway. And in Morocco, we've seen the deadliest earthquake in more than 6 decades that have claimed nearly 3,000 lives. Rescue operations continue with search teams from Britain, Spain, Qatar, and who are assisting the Moroccan military. Meantime, North Korea's Kim Jong-un has arrived in Russia for an expected meeting with the Russian President Vladimir Putin. This meet has sparked concerns about a potential arms deal for Moscow's war in Ukraine. Remember, after decades of complications, hot and cold relations, Russia and North Korea have drawn closer since Moscow's invasion of Ukraine in 2022. And Republican lawmakers have launched an investigation into the possible impeachment of the US President Joe Biden, but such a prospect remains highly unlikely. They've accused Biden of having lied to the American people about his son Hunter's controversial business dealings abroad. And to the world of sport then, India beats Sri Lanka by 41 runs to seal the spot in Asia Cup finals. Skipper Rohit Sharma top scored for India with a 53-run, while you had Daneth Welage of Sri Lanka, who was declared player of the match.
All right. What is the cover on D Street? Sharad is standing by.
Well, yes, in focus we are having Westlife Food World and 2 important buzz coming in for the stock. The first one is the company is expected to launch an important loyalty program for its customers, and also secondly, the company plans to introduce chicken wings to their offerings, and this will be coming in, of course, on the fried chicken front as well. Also, do remember that the company itself, they are aiming to double their revenue over the next 4 to 5 years to the range of almost roughly 4,000 odd crore rupees. They're planning to add roughly 200 to 300 stores, and the SSG growth that is estimated to go up between 7 to 8 odd %. Company has also maintained a guidance on the operational front between 18 to 20 odd %, and two important new buzzwords coming in. First is, of course, the raw material inflation problems that has actually subsided, and the omni-channel expansion plan that is on. But do remember, over the next 7 days itself, especially in the western markets, because of the onset of Paryushana, expected that the sales might be muted. But overall, if you look at the stock itself, that has jumped almost 50% over from March lows.
Some loyalty programs, that's what Westlife Food World is expecting. My stomach is growling, Nikunj.
No, Avan, it's the QSR space, I think, has done very well for itself.
Yeah,
but if
and
this
stock has as well.
But what are the valuations? Yeah. I mean, you're looking at some 100 times for a company. I mean, 70, 80 times for the P multiple. All I'm saying is that, okay, this is how things would move in terms of the per capita migration. Indians are just about experimenting in terms of quick dining or the QSR experience. It's a very finely run franchise, great mod, driving experience. You want to grab a burger on the go. But the whole challenge with Westlife is, and I was looking at the numbers, I just don't recall every, the fine print here, but I remember looking at the numbers and I said, okay, stocks at 70, 80 times, can they really create a lot of wealth? My limited point is that in India, there are a lot of stocks which are good, a lot of businesses which are great, but there are a lot of valuations where markets are pricing in FY 26, 27 and even 28 earnings, and I think that really seems to be the case in some of those stocks. Meanwhile, there is a upgrade on Zomato which has come from Elara, and they're talking about 130 rupees. So what a churn it's been, what a turn it's been for Zomato, Policybazaar, and even Paytm. If there is one space where you definitely want to be a buyer on a decline, I think it's this space, because we've discussed with our technical experts that if you look at this year's rise in some of the consumer tech and fintech stocks, it in a sense has happened after a great decline in 2022 and the first half of 2023. So if you're looking at a pocket where you want to be a buyer on bad days, would be this entire basket of consumer tech and fintech stocks. Now when it comes to railway, defense, two-digit stocks, just understand one word: risk management and margin of safety. And Kunal, the word risk management is crucial so that you don't lose capital, and margin of safety is something which will bail you out on a bad day. And I think for a lot of stocks in defense, railways, two-digit stocks, power, that is not there. That's the limited point, right?
Absolutely. So
argument.
There was a phase in August and September where return on capital is more important. Right now, return off capital is most important. You have to ensure that you don't lose out the advantage you've gained maybe over the last couple of months or last 3-4 months in terms of trading. So that's why risk, mitigating your risk or cutting your risk is very, very important and crucial in this kind of a market sense, because it's very difficult to anticipate on the first day that how sharp, how deep, in case the correction extends, could be for the markets as well as for the overall stocks.
All right, let's just quickly also check in on some stocks that had a fairly decent move in the week gone by, the likes of Praj, eClerx, Axis Bank, Hero Motocorp. They've all been smart gainers. On the flip side, Natco Pharma, Weber Global, MRPL have been on the losing. And we'll discuss some of these stocks down the line, but it's interesting because we're taking stock of what's happening within banks. They're in the spotlight. Are they going to be the new defensives, and what exactly does that mean for the market? Let's hear out Nikunj's take.
I would stick my neck out because, with banks, they have this reputation of being volatile. So, of course, banks will be volatile. That's the nature of the business. But in the near term, when I say near term, you say anything defensive. Why? Because you expect it to fall less and you think there is visibility. Where in the market can you see there is visibility and there is a comfort of valuation? Very few sectors. Banks is one of them. The YTD move in the bank Nifty versus Nifty underperforming. The most talked about sector this year actually has underperformed. Throw in the macro elements, well, interest rates are looking benign. NPA conditions are looking okay, and the credit offtake I think is decent, even if you look at the retail side and if you look at the unsecured and the secured loan. That I think is important. Then other valuations, whether it is Kotak Mahindra Bank or whether it is whether it is HDFC Bank or whether it is Axis Bank, all these stocks are nowhere close to the historical averages. State Bank of India has done hardly anything. Now that's how things have moved actually 12 years forward. See this, let's spend some time here, Avan. This is a 5-year average.
Yeah.
So on a 5-year average, Kotak Mahindra Bank has commanded a price to book of 4, which means 2.8 is the current price to book. So Kotak Mahindra Bank is trading at a discount to its historical average. And growth in next 5 years will be higher than the previous 5 years.
So that's,
Growth will be higher and valuations are cheaper. Then when you see a equation like this, when X equal to Y, that is the time to just buy. So I think this graph, I think is very simple to explain that why banks have a scope to outperform and why they really could be the new defensives.
Find out what the top index calls are as well. What is it that our chartists are inching towards? Remember, yesterday was quite different from what the week started off from. So here's the take. Book profits, according to Kunal, avoid completely, says Santosh Meena, and Naresh believes that it's a hold recommendation on the markets. A quick check-in on the Nifty Bank Index as well. That's the call coming in from our chartists.
Where the pre-open rates have settled in at, and what is it that we are in store right now in terms of a market mood, indicating a little bit of a mild tempered start, 19,989, although the GIFT Nifty, the implied open for the Nifty futures, was indicating further upside to the 20,046 level where we left it off on the Nifty futures. Kunal, but do you sense that we'll be sub the 20K mark on the index?
Yeah, I think we should be sub the 20K mark for the index for at least some more time, and that would not be a bad or a ominous sign for the index. But the only concern is that whether the large caps would shield the market relatively on a sustainable basis. If that's the pattern, then hopefully we can expect the index to maybe stabilize at current levels and then probably build up gradually and start to move up higher. But if the large caps also start to get into selling pressure, if there is mark-to-market pressure which happens into the mid-cap names and that pressure gets added on to the large cap stocks, then we may expect the index to start into a corrective phase. So as I said, we'll have to wait out for another couple of days how the patterns play out, whether the stocks which have been beaten down in the last, in fact yesterday, whether they see any sustainable recovery or that recovery or a bounce is taken as an opportunity to sell. So all of that positions or the mitigating of those positions would probably help us decipher the next set of trends.
Sure. Naresh, we've talked about where you see the strength across large caps, and that's largely IT and banks. But what's looking like the weakest link amongst the large cap names?
So the weakest links are still not yet out because we've just made a new all-time high on the large cap. So the weakest links are on the mid-cap, small-cap side because that is where craziness has happened. We've gone nowhere on the, the large cap. So too tough to call a weak sector as such. You can only call the heavyweights which are not doing anything. So Reliance and HDFC Bank, which have been at the same price for almost last few months and a couple of years, you can say in terms of relative outperformance. So that's the weak link in terms of not doing anything. But apart from that, the large caps, we've just started seeing a breakout move in banking names, etc. So too early to call a weak name because we've not actually gone up a lot on the large caps.
Just about 50 seconds to go. Actually, Nikunj, I'm going to hand it over to you.
No, you can also do market open.
But I think people wait for your take.
Not that anybody is expecting anything large today.
Yeah,
I mean, all we need is stability.
Yeah.
You should stop falling. And if
particularly in the broader markets, yeah.
Yeah, and you may just not get that semblance and that stability, for next couple of days actually, because a fall like this just does not get cleaned up in one day. But I think I was wrong. Some of the market surprises you, right? And you live and you learn. There is a green already on the screen in some of the railway, defense and some of the high flyers here. So 12 seconds to go. Banks on one side, mid-cap, defense, two-digit stocks and railway stocks on one side. Let's see how things actually move. I'm just going to load up my monitor here so that we all get set to go and I can just capture the first rates. First rates, any seconds now, and it's not, nobody really is talking about the Nifty here. Everybody, however, wants to know that where the mid and the small cap stocks in a sense have started. So Nifty is off to a flat start, which is on expected lines, but you want to look at Bata India Power 3% down, Brightcom 4% up, IRFC 2% down, Suzlon 2% down, JP Power 1% up. I'm just rattling numbers here because that's what's happening. Interesting for me is Suzlon, which is off circuit. Interesting for me is GTL Infra, which is bouncing back up. There is Yes Bank, which is at 17.5. It is not a scary start, guys. It is not a scary start. So, I mean, you may say that yesterday's price action has left a lot of bitter aftertaste, but today's sweetener will wash out a lot of yesterday's bitterness. That's what I can say, because the screen is not looking that bad. Unlike what we thought in the morning when we looked at technicals, momentum, and other indicators and valuations, that we could be in for a very volatile and a weak start, I think the market has delightfully surprised, as always, again.
Yeah, a bunch of stocks which are in focus as well, and let's look out for what NTPC is up to. They've completed the trial operations of the first unit of the Telangana super thermal power project. That stock is still going gung-ho, 1% higher nearly for that one. There's Dixon Technologies. They've incorporated one of their arms, Dixon Infotech, for now laptops, desktops, and LOT device maintenance as well. KC International, sizable orders across various businesses worth in excess of 1,000 crore rupees. KC International has gapped up 6% as we speak right now. Besides that, of course, a bunch of other stocks which are in focus. We've been marking what's happening outside of the index, and BHEL, Indiabulls Housing, REC PFC, these are stocks that I definitely want to revisit. BHEL has stalled the fall but started off quietish, flattish at that 125 thereabout level. PFC is actually seeing a jump up, about 0.5% uptick coming in there, and is gathering only further momentum. Flat start for REC, Indiabulls Housing, GMR Infra. That sort of gives you a sense of what the liquid universe and the texture of the market is this morning. REC as well mildly in the positive, and it's a very positive move actually for Indiabulls Housing. It's almost up 3% after that 9.5% fall in the stock yesterday. What about IT, TCS, Infosys? They were all the winners yesterday. Let's revisit some of these large cap names. TCS corrects a little bit, 35.50. Infosys as well a little bit soft. L&T and ICICI Bank are the other names that I just want to revisit and show you what they're up to in trade. L&T will just come up for you on your screen. It's down about 0.5%, and ICICI Bank, that as well starts off in the red. So Kunal,